Thank you very much. There's a lot of space down in front. Students always sit in the back. They like the perspective. Let's see. Okay, here we go. So I'm very happy to be here. My first time in Warsaw, and I just walked through the park this morning to wake up a little bit because I'm 6 hours different than you. So you'll excuse me if I'm a little sleepy sometimes, but I will get more energy as I speak. There are 5 lectures here that I have planned, and maybe you have this program in front of you. This first one is meant to be a general introduction. Why is money difficult? And then tomorrow we'll do sort of history of money, which may be more familiar to you because it's all the things that you will have learned in classes and where they came from and how they're evolving. And then Friday is the core idea, fundamentals of the money view. And then you have a weekend to absorb all of that. And then next week, on Monday, we have the past, present, and future of shadow banking, which you'll see why that's important. And then Wednesday, understanding global money is the wrap up and putting it all together in one piece. But I thought I would begin today since it's important to as a setting to appreciate that we had this global financial crisis 10 years ago. 10 years ago to you seems a long time ago, but to me it seems like yesterday. And it was very much this was what upset all of economics because standard economics had no very good answer for why this was happening. People didn't see it coming. When it happened, they didn't know quite what to do about it. And then when it was over, they weren't sure how to change economics so that we would understand it. And so they decided to sort of push it away and pretend it didn't happen, or that it was just a lightning bolt from the gods. And now it's over and we can go back to business as usual. But I don't think so. That's what I'm going to be arguing in this next week. I think that the global financial crisis, GFC is for global financial crisis, was many things, and the reverberations of this crisis are continuing to this day. It's a big stone thrown into the ocean, and the waves, the tsunami, continues to this day. At the very microeconomic level, I would say, it was a crisis of risk management system for banks. So the idea that you could control risk in a bank through value at risk, very technical methods that you might have seen in some of your classes, and the Basel idea that as long as you have enough capital, risk-weighted capital, you'll be fine. It was a challenge to this standard risk control ideology in standard banking. It was a challenge also to macroeconomic management. This idea that if we just do inflation targeting and make sure that consumer prices are stable, that's enough. Okay, that will lead to stabilization. You don't remember this, but I remember before the crisis, there was a great sense of pride in macroeconomics, the great stabilization that somehow we had solved the problem of business cycles and so forth. And the global financial crisis showed that this was just not true, okay? That there had been difficulties building up in the system that we hadn't been aware of because our theories abstract from these things, so we didn't really even see them. So it's a challenge to our system of public and private risk management. It's also a challenge to political economy, how it is that the monetary system interacts with the political system. So the relationship between the central bank and Wall Street in the United States, because as you will see, the central bank played a very large role in preventing the system from collapsing. That meant that it had to help very large banks that had caused the crisis. Okay, so this is a big political trouble in the United States, and it's continuing. And you'll see, particularly when I talk tomorrow about the history of money and banking in the United States, it's always been a struggle between the relationship of democracy and the relationship of finance. And so this has to be renegotiated, and it's in the process even now. This was a crisis in Europe too. There, because it was much more about the political economy between the central bank and the state treasuries of different countries. It was about the integration of Europe or disintegration of Europe, and the different qualities of different kinds of state treasury bonds. And at the global level, the relationship between central banks. You will see, as I will say, that in order to put this crisis away, to put a floor on it, it required enormous cooperation between particularly the biggest 6 central banks in the world, trusting one another, and that they had never done before except in wartime. And so creating some new facilities, liquidity swap facilities, and that's still evolving. What is the relationship? It's a global system now, and yet the dollar is the center of the system, and what is the relationship between the Fed and the ECB and the Bank of England and the Swiss National Bank and the Bank of Japan and the Bank of Canada, these being the 6 major central banks? And how does that then connect farther down in the system? This is still a work in progress. So the global financial crisis was a crisis of political economy, as well as a crisis of risk management. But the thing that I particularly want to draw attention to, and that will be the centerpiece of that connects all of these, is that it was a crisis of the global liquidity system. Which is, first of all, important to say that it's a global system, that it's not individual countries, it was a global system. And liquidity being an idea that most of our economic theories abstract from, so that's why we didn't understand it. That this is a system that has been evolving since World War II, when the international financial system had basically collapsed in the Great Depression and in wartime. And then it had grown from the 50s and the 60s and the 70s and the 80s and the 90s to be an entire thing that was not very much in our theoretical realm. And we managed to save the system by changing the role of the central bank. That the central bank was involved in lender of last resort, funding liquidity, but this new idea of market liquidity also supporting financial markets, not just lending to banks that had a liquidity crisis, but actually supporting the value of key financial instruments, residential mortgage-backed securities in the United States, but also state treasury bonds in Europe, dealer of last resort. We're going to see some of these ideas in the days to come. These are just, so that was a long introduction. This is some images to just make you aware of what a big thing happened in 2007, 2008. This is the balance sheet of the Federal Reserve in the United States. On the top, it's a measure of the assets of the bank, and on the bottom, a measure of the liabilities, which are measured negatively, so that you can see them going down. And the 2 vertical lines there, I think I have a laser pointer here. Yeah, this is the fall of 2000. This is March of 2008. This is when Bear Stearns collapsed. It was a big investment bank. And most people were not aware we were in a financial crisis yet. Okay, what most people became aware that we were in a financial crisis was here in September of 2008 with the collapse of AIG and Lehman Brothers. But what you can see in this balance sheet is the different ways that the central bank was fighting this crisis. The crisis actually began, okay, even before Bear Stearns, okay? And the first thing that the central bank did was to lower the discount rate, to lower the interest rate from 5% to 2% in various phases, thinking that would be enough, and it wasn't enough. During this period in the middle, you can see what happened was the central bank liquidated about half of its balance sheet. It was holding treasury securities, and it lent those proceeds to banks that were in trouble. This is lender of last resort. This is when the central bank was trying to support other investments banks. Bear Stearns has just fallen, and it's lending these proceeds to other broker-dealers. This dark blue, this is treasury bills. Okay, this dark blue, this is currency on the balance sheet. So you can see that before the crisis, the central bank was a very easy, simple thing. Okay, currency on one side of the balance sheet, treasury bills on the other side of the balance sheet, small amounts of everything else. Really, it was a very simple little thing. And in the middle of the crisis, it liquidated half of its balance sheets. That's $500 billion, okay, $500 billion, and lent the proceeds, and that wasn't enough. And so after AIG and Lehman Brothers, it went even farther, and now it's expanding its balance sheet on both sides. It's issuing deposit accounts here, okay, and it's lending the proceeds to other central banks, particularly Central bank liquidity swaps, this $600 billion to the ECB, the Bank of Japan, and other central banks. And then it starts buying residential mortgage-backed securities directly, over $1 trillion worth. This is what I call dealer of last resort. So this image, I mean, we can talk about the details of it, and it's not your central bank, but it is a kind of a, we have this expression, through the looking glass. Alice, you know this fairy story? Okay, about through the looking glass, that this shows you something big dramatic happened in 2008. And it actually transformed the Fed's balance sheet, and it's still transformed even today. Even today. It looks much more like it did this is just March of 2010. It looks very much like that even today. So this was a moment of big change that we're still trying to understand what does it mean for the future. And all central banks today are talking about exit. You may see this. They're imagining going back to life before the crisis. Okay, but how to do this? You know, this transformation happened in a matter of a year or a few months. Okay, and now it's 10 years later, and we're still there. Okay, so the transition. Why is the transition back so much harder than the transition to this? And maybe it's not even possible. Okay, this is what we have to be thinking about. This was a big transition of the balance sheet of the central bank. I'm going to show you this just quickly. This is another thing that happened in the crisis. Was it was a global crisis. It wasn't just the central bank of the United States. It was all central banks. And this is the global price of money that I'm showing you. In fact, this is the spread between the price of borrowing dollars in the United States and the price of borrowing dollars outside the United States in the euro-dollar market. You would think that those would be the same number. Okay, that through arbitrage or something, that the price of borrowing dollars outside the United States, inside the United States would be the same. Because if it was cheaper in the United States, somebody will borrow in the United States and then lend outside the United States and make that spread. This is that spread. And of course, before the crisis, the spread was zero. You can see. But you can see the crisis beginning in August of 2007. Okay. Everyone like me who reads the Financial Times and looks at these prices knew in August 2007 there's crisis happening, okay? Because this spread that should be zero went to 100 basis points, a full percentage point. That's a very big incentive, okay? And yet no one is doing this borrowing, no one is doing this arbitrage. This means that the world money markets are very, very much gummed up. And then Bear Stearns, and you can see that spread got stabilized by somebody, okay, the central banking system, and then that wasn't enough. And it went not from 100, but to 300 basis points after AIG and Lehman. The world money markets, the global money markets broke down in the world as a whole. You couldn't borrow money. You couldn't roll your balance sheet. This was, if this had gone on, it could have all collapsed, and a Great Depression, another Great Depression was very possible. Very possible, but it didn't happen. The central banks supported the global system, and we're still here. This is the phenomenon that we need to understand, that we need to prevent happening again, and understand why it happened in the first place. And this is why we have such difficulty understanding it. The fatal abstractions of modern economic thinking. Abstracting from representative agent is a common assumption in order to make our life easier. Assuming that we're living in a world of intertemporal equilibrium. Thinking about money as if it's a veil, as if we can abstract from it and just think of people as trading commodities and services directly. Ignoring the legal foundations, the connection between the political system and the monetary system, and ignoring market microstructure, how markets are made, what dealers do. These are standard abstractions in modern economics, okay? And it was because of that we had blinders on and did not have the intellectual apparatus to understand what was happening. And that's, I think, a call for action, a call for new economic thinking. And I have proposed, this is why I made the MOOC, which some of you have seen. It was referred to. I've been teaching money and banking at Columbia University for a long time. I've been teaching for 30 years, actually, but for 15 years I had been building this course called The Economics of Money and Banking that INET filmed in the fall of 2012. And you can go, it's a free course on Coursera, anyone can go and see the whole thing. It was filmed live in a lecture hall very much like this one with my students in the fall of 2012. This is a way of understanding money that I had developed over 15 years, and it has two main ideas. Thinking about banking as a payment system. Usually this is abstracted from in courses in money and banking. And thinking of banking as a market-making system. And these are some of the names, some of the people that I built on. We're going to hear more about that next time. But what I am proposing to you is that there is a way to understand, there is a way of thinking about money that does not abstract from payments, that does not abstract from market making, that does not treat money as a veil, okay? And that maybe it's time to revive that tradition and to bring it more into center attention. That's what I tried to do in my course, and that's what I'm going to try to do this week. Okay. So that's by way of introduction. I've been teaching money and banking for a long time. Now, and I have observed, well, first of all, you have to teach it to yourself, and you have to find out, why am I not figuring this out? What's wrong with me? What's wrong with my head? It's a lot of that I had learned good economics, and so I had learned to abstract from certain things that now I'm trying to understand, and that causes a little problem in your head. It's hard to learn new things if it requires you to unlearn other things, or to question things that you thought were the basis of your knowledge. And so I now begin by trying to introduce you to open your minds by confronting that. I've asked myself, why is it so difficult for me to learn this and figure this out? Why did it take me so long? I don't think I'm stupid, okay? But maybe it's just hard. Maybe the subject is hard. And what makes it hard? And I understood this for myself and also now for students. Why is it so difficult for students to learn this? Particularly very good economic students who are very well trained, and so they have adopted all of these ways of thinking about the world that makes it difficult for them to think about money. So let's bring these up to consciousness and become aware of them so that they won't be, when we have some difficulty, we know where it's coming from. Okay, why are we being uncomfortable about this? And so there are four of them, and that I'm going to talk about. The first one, and I think for good economic students, the most difficult obstacle, is alchemy, okay? The apparent alchemy involved in banking. That banking is a swap of IOUs, okay? That is to say, I say to a bank, I owe you something, and the bank says to me, I owe you something. And that's what I'm showing in this balance sheet here, okay? This is a swap of IOUs. The bank is lending me some money, and it's doing so by creating a new liability on its own balance sheet. Okay, so that's a loan as an asset of the bank, and that loan is a liability of me. Okay, that a deposit account is a liability of the bank, and it's an asset of me. Okay, it's a swap of IOUs. It does not require any resources at all. It's just an accounting entry, and yet it does something. This is the fundamental alchemy of the banking system, and it is true. And it is upsetting for us psychologically. And why is it upsetting? I'm going to come back to this at the end, you'll see. I think that it's a psychological barrier that the normal, kind of normal language view of a loan is that I can't lend you a bicycle unless I have a bicycle, okay? And if I lend you something that I don't own, that's illegal or fraud or something. It's a problem. Okay, how can you lend something that you don't own? There's a further problem that comes from the notion that this swap of IOUs, since there's no real resources involved, how can this possibly do something in the world? If it does something in the world, this seems a violation of a fundamental economic principle. There's no such thing as a free lunch. You know, that if it doesn't require resources, how can it possibly be important? How can it possibly do something in the world? It seems a violation of a fundamental economic principle. And it seems also as if I'm getting a loan, which I didn't do anything for. I didn't sell something. I didn't provide labor. It's just I'm promising to pay, and I get purchasing power to buy something now. Okay? That seems like there's not a barter here. I'm getting something for nothing. That seems not right in some way. And yet, So I'm just saying, these are things that are upsetting to us, that are psychological points of resistance for understanding how banking works. But it's very important to say that this is how banking works, okay? That it's the inside or credit character of money, that it's the expansion of balance sheets that's going on, that is a violation of our own understanding of money. You and I can't create money, you know, but through the interaction with banks, money is created. This is the nature of the system, and we need to understand that this is how it works, but how does it work in particular? What is the microeconomic logic of it? So that's the first one, and I think probably the hardest one. That's why I start with that one. The second one is appreciating that modern monetary systems and even ancient ones are essentially hybrid, meaning they're a mixture of public and private money. So I'm showing you again a balance sheet. You're going to see lots of balance sheets in this week, so I'm getting you used to that here. I'm showing currency as a liability of the central bank. That's public money. And I'm showing deposit accounts as a liability of a private bank. That's private money. In our normal lives, we treat these as if they're interchangeable, that you can go to the ATM, okay, and access your deposit account and pull out currency. So you can move from deposits to currency and you can move back and forth. That there's a price though there that's par, okay? They trade at par, but one is private money and one is public money. And this is true at higher up in the system as well. I'm showing you here the balance sheet of the central bank. That typical central banks are both a government bank, public, okay, and a banker's bank. They're a bank for the bankers. And you can see that on the balance sheet of the central bank here, that central banks typically hold treasury securities, so that's government securities, and they have a bank account for the government, the treasury account. So they're like a government bank, but they're also a banker's bank. They hold deposits here of other banks that use them as reserves to make payments to each other, and they have discounts to other central banks and other loans of other kinds. So they're essentially hybrid. Central banks are also hybrid. The monetary system is hybrid, both public and private. Now, this causes further intellectual problem for us, this feature of the system, because you'll see, and we're going to, in some of the readings you've chosen to discuss, like this afternoon, on the political left, there's often a view that money may be hybrid, but it shouldn't be. Okay, that it really should be state money. That when the private sector gets involved in this, it's getting involved in something that is none of its business. Okay, and it shouldn't be involved in this. It really should be a matter of the state. Money is essentially a creation of the state. And it's illegitimate when the private money gets involved, okay? And so you hear many proposals like 100% money or things like that for getting rid of private banking, that everything would be fine if we just got rid of private banking and only had state banking. These are some of the names: Chartalism, Knapp, who was a German monetary economist, modern monetary theory. We're going to be talking about some of that. That's sort of their position, where they're coming from, is the notion that maybe the system is hybrid, but it shouldn't be. And that comes from a political kind of view, and a view of what money essentially is, that it's a creature of the state. There's the opposite view from the other side of the political spectrum, which is that the state getting involved in money is illegitimate, okay? That money really is a private creation, that it's about trust and about business relationships, that it arises from business interactions and private interactions. It's a creation of the marketplace. Not of the state. And when the state gets involved, then it's illegitimate. It's interfering in private commerce, and it should just get out of the way. And the reason there are problems is because the state involvement. And if you just got rid of it, this would be fine. So these, of course, are equal and opposite positions. And my position is a third position, okay, which is that both of these are wrong. Okay, that the system is hybrid. It's public and private. Each one adds something, and they mutually support each other. It's a symbiotic system. It's not that one is illegitimate and the other one is legitimate, and then we have to decide which one is legitimate and get rid of the other one. We have to manage a system that has both features, and in which the liabilities of private banking and the liabilities of public banking trade at par. How do they trade at par? What makes them trade at par? And when there's stress on the system, that par is under pressure. That was what was going on when the global money which I showed in those prices, that spread, global money, it costs 300 basis points more to borrow dollars in private money than it was in public money domestically in the United States. That was a threat to global par in dollar. We're going to talk about that. So my image is a symbiosis. This is a picture of lichen that grows, I don't know what the Polish word for this, it grows on rocks, okay, and it's a symbiosis between algae and fungi that are, it's not one plant, it's two plants that are growing together. It's a hybrid, each one of which could not actually survive without the other one. And it's a very, you can find lichen anywhere in the world because it can combine in different ways. It's much more successful than either of these plants would be by themselves. So that's my image of lichen on a rock is the nature of modern money. It's essentially hybrid. Now here's the third one. The third reason that we find money difficult is that the system is essentially hierarchical. The monetary system is essentially hierarchical. I'm showing you here the hierarchy as it was under the gold standard, in which gold was the international money, the best money in the world. National currencies were promises to pay gold under the gold standard. And then private banking deposits were promises to pay national currency, and then securities are promises to pay deposits. So it's hierarchical, it's promises all the way up, but it's clearly hierarchical because everything is eventually a promise to pay gold, but indirectly. Securities are promised to pay deposits, deposits to pay currency, currency to pay gold. It's a hierarchical system. And we need to bring that into a central place in our analysis, or we don't understand how it works. Bringing it into a central place in our analysis, however, is a problem, a mental problem for us. Because we have these political ideologies, or I say economic ideologies, that men are equal, markets are equal, all commodities are equal, that the system is flat. This is how our theories work. It's right, it's commodity A, commodity B, commodity C. We don't have a hierarchy, and they're just different prices. It's not a hierarchical system, they're just different prices, and prices make everything equal. That's sort of the theory of economics. And it connects with our political theory, that all men are equal and women are equal, and yet we look out in the world and we see the liabilities of men and women are very much unequal. Some institutions have the ability, their liabilities are money. Not my liabilities. You know, my liabilities aren't money. My liabilities are credit. Okay, but Citibank's liabilities are money. That seems not fair in some way. It's not equal, that it should be equal. And similarly, the Westphalian ideology, the notion that every country is equal, right? That somehow Polish money and American money are the same kind of thing, and they should be at the same level. Like in the UN, everyone gets one vote, okay? But in the global monetary system, not everyone gets one vote, okay? US money, dollar money, is global money. Polish money is not global money. That doesn't seem fair. It seems not right somehow. And so we don't want to build theories about something that's not right. We want to build theories about an ideal, but that's a world that doesn't exist, okay? The world that as it exists is hierarchical. Why is it hierarchical? How does it work? This is what we need to understand. We need to understand that credit is a promise to pay money, and money is the highest form of credit, the best credit in the world. That's why it's hierarchical, that money is a form of credit, and that credit is tiered, that some credits are better than others, and it's a hierarchical system. This is difficult. I can see that this is uncomfortable. We're uncomfortable with hierarchy, and we're uncomfortable as economists. When we hear the word hierarchy, we think of power, we think of monopoly, as opposed to markets. We're in favor of markets, okay? Markets are flat. But I'm saying here at the very center of the market system, the monetary system is not flat. It's not flat. And as we'll see, there are reasons it's not flat, and probably cannot be flat. So we need to adapt to that and understand that phenomenon, and how we can manage that system for the general good. So that's the third one. Well, I can see you're getting tired. This is a big psychological trouble, okay, to bring on board these threats to a way of understanding the world. So here's the fourth one, which is also difficult for economists, that the system is essentially unstable. This is a phrase, Ralph Hawtrey, great monetary economist at the beginning of the last century, spoke of the inherent instability of credit. in a beautiful book that he wrote called The Art of Central Banking, the inherent instability of credit. He worked at the the British Treasury. I'm showing here an image. I said that the system is hierarchical, and I showed that pyramid, right, with gold at the top and credit at the bottom. Now I'm showing how that pyramid changes over time. That in boom periods, it expands. Credit is expanding here on the horizontal axis. Liabilities are expanding in one direction, assets expanding in the other. Credit expansion. And in that expansion, it's also true that things that look like credit in bad times begin to have more money-like features. It becomes much easier to spend them, and people accept them as means of payment in a boom. And then in a bust, the reverse. Okay? The hierarchy reasserts itself. The system shrinks. The difference between money at the top and money at the bottom becomes wider. And this is the nature of the system, that it fluctuates like that between expansion and contraction. And it does this at every time scale. You see something like this happening intraday in the payment system, expansion of credit and then resolution of credit at the end of the day. In business cycles, expansion and contraction. You probably thought I was just talking about business cycles. And also the life and death of nations. Monetary systems expand. You know, the British pound was the center of the world system, okay? And then they shrink and something else replaces them. The dollar replaced them. And so this is a drama of the monetary system. And this is difficult for well-trained economists to appreciate, the inherent instability of credit, because it suggests that the instability is coming from inside the system, from some feature of the system, dynamics of the system. And we're used to thinking about equilibrium, thinking about a system in which prices are clearing markets, supply equals demand, and time is just an additional dimension of the commodity space that we're just borrowing. We're selling commodities today and buying commodities tomorrow or something like that. Sounds like you're used to that. That instability, if there is any, comes from outside. It comes from political interference with markets, okay? Or it comes from a bad realization of a crop or power, you know, some riot somewhere. You know, that markets are a stabilizing force. And so we always prefer markets over politics. And what this is suggesting is that markets have their own inherent instability. That's an uncomfortable thought. But it is the nature of the system that we're looking at. And not looking at that thought makes us unprepared for the instability when it does arise. So we need to confront that, look that in the eye. Here's the lesson I take, that incipient incoherence between cash flows and cash commitments are absorbed by balance sheet expansion higher up in the hierarchy. That might not mean anything to you right now, okay? But it will by the end of the week. That where does this instability show up? So these are my 4 troubles. Now I want to give you an image. How are we doing on time here? We've got plenty of time. An image of the economy of the monetary system that we're going to explore in more detail in the next several lectures. A money flow economy. This is a 1-paragraph summary of it that I put in the first pages of my most recent book, The New Lombard Street, to try to orient people before reading this book. To think about the economic system not as barter, trade between different commodities and there's prices. That's how economists normally think about it, right? But think about it like this. Think of it as a web of interlocking commitments, debt commitments, promises to pay. Each one a more or less rash promise about an uncertain future is like a bridge that we collectively spin out into the unknown future towards shores not yet visible. So we're making promises to do something in the future, and we don't know what the future looks like. So that's why it makes it rash, right? That we're, I'm going to try. It's like marriage. I'm going to try. We'll see. It's in the daily operation of the money market that the coherence of the credit system, that vast web of promises to pay, is tested and resolved as cash flows meet cash commitments. The daily operations of the money market. Here I'm talking about the payment system. I'm talking about settlement. That when you make a promise to pay, okay, As we say, it's a rash promise. We don't know, but it's saying on a certain date in the future, I promise to pay you $100. When that date comes, do I pay it? Do I not pay it? Am I able to pay it? It's not just that I'm a bad guy and I run away from my debts. The question is, I might be a good guy, but if I don't actually have the cash, I am not able to pay it. And that is the discipline that coordinates the system from a money view perspective, okay? It's that discipline of arranging your affairs so that you're trying to meet your commitments. You make certain commitments in the future, and then you arrange your affairs to try to get the cash flow coming toward you so that you can make those payments. Everyone is doing that. You're doing that. Your boss is doing that. Firms are doing that. Nation states are doing that. Everyone is doing that. The global system is this system of interlocking debt commitments in which everyone is making rash promises and then scurrying around trying to figure out how to actually fulfill them. Okay? And that's the image of the economic system that I want you to have in your mind over the next week. And at the end of the week, ask yourself, does this help me understand the world outside the window? And if it does, then you will continue to push farther and learn more about this. But this is not the standard image that you get in introductory economics. But it is the image of all of the people that I have learned from in the money view. They have some version of this in their mind and it's a natural image, by the way, for bankers. So if you went into the world of practical banking, even if you just never learned anything about banking, by engaging in banking, you will develop this worldview just by being involved in that business. Whether consciously or unconsciously, mostly unconsciously, you will develop a worldview like this. It's the worldview that makes sense for banks because they are quintessentially confronting this problem of cash flows and cash commitments because their liabilities are promises to pay on demand. So every day they have to worry. People are writing checks on these accounts. They're transferring them to someone else. How am I going to satisfy that? I need to make sure that maybe I have reserves, but I'm not going to have enough reserves to cover all of those liabilities. Otherwise, I'm not going to make any money. How much reserve should I hold? How can I borrow reserves when I need reserves in the money market? This is the quintessential banking problem, is meeting the liquidity needs, cash commitments and cash flows. It's not a budget constraint, right? You're all good economists, so you know about budget constraints, right? And households maximizing their intertemporal utility by organizing their consumption across time compared to their income across time, confronting a budget constraint. It's not the budget constraint that I'm talking about here. This is the settlement constraint. It's about paying cash when you promise to pay it. And if you can't, finding a way to borrow it for another day and live another day and pay it tomorrow or the next day. This image, settlement is coherence. Here's an actual picture of this. That when I say that the web of commitments is like a bridge we spin towards shores not seen, okay? Here is a picture of the building of the Golden Gate Bridge, okay, in San Francisco. Has anyone been to San Francisco? Yeah, you should go. It's a beautiful bridge. And here's where it's being built. And you can sort of see the shore off in the distance there. It's a cable bridge, okay? And they're building it out over this long, rather rough water. That's the credit system. That's what the credit system is doing. It's building a bridge toward a distant shore. And sometimes when you get near that shore, it turns out there isn't a shore there. And then the bridge collapses back, okay? And you start to build in another direction. That's what financial crises are like. That's what they're about. You're building in a certain direction, imagining a certain future, and everyone is on board and they think that's the future. And then it turns out, no, we were wrong. That future is not possible. And so you retreat. Some of those promises to pay default, they collapse, and you start to build, you come back to where you had a pier, a solid pier, and you build in another direction. This is the image that I want you to have for the next week, and think about how it's useful to you for understanding the credit system. And here's a second image. This is building on the notion that the system is hierarchical. Here in the left-hand column, these are the same elements that I had in my hierarchy of money. gold, currency, deposits, and securities. Okay? But now I'm showing a set of very key institutions that are bridging the layers of the hierarchy. I call them market makers. Okay? That have one foot in one layer and the other foot in the other layer. Okay? So what is a central bank? A central bank has currency as its liability, we've seen that, and in a gold standard it's going to have gold, some gold reserves as an asset. And it is, when I say that currency is a promise to pay gold, who's making that promise? The central bank is making that promise. Who's fulfilling that promise? The central bank is fulfilling that promise. The central bank is a kind of market maker. It is making the exchange rate. It's backing that exchange rate, the exchange rate between currency and gold. And farther down in the hierarchy, banks are doing the same thing, but between different kinds of money, between deposits and currency. I said that par is the price of deposit accounts in terms of money and vice versa. Who is making the market? Who's making that price? Banks are making that price. When they're opening a deposit account, they're promising, I will maintain par. I will give you currency for deposits whenever you want. Okay? And they have to engage their business in order to maintain that. And farther down the hierarchy, we have security dealers who are maintaining markets between securities and deposits. These aren't fixed prices, right? Securities fluctuate in price, but they nonetheless have a market price that you can buy and sell them. If you tried to sell Apple stock tomorrow and somebody said, well, there aren't any buyers, okay? It has a market price of 0. Okay? But that's not what happens when you sell Apple stock. When you sell Apple stock, the person on the other side of that transaction is almost always a dealer who is quoting a buy-sell spread and saying, I'm willing to buy it from you at this price, I'm willing to sell it to you at this other price, and they're managing that price, similarly to the way banks manage the price of par and central banks manage exchange rates. So I want you to have this image that behind the scenes of the market system, there's this dealer apparatus at different layers that's knitting together the layers of the hierarchy as a business, as a profit-making business for security dealers, as a profit-making business for banks. Central banks are different. They don't necessarily have to make a profit. They're worrying about the stability of the system as a whole. They're sitting at the top of it, okay? But their dealer function is the same kind of function that's being played by other players farther down. So this way of thinking about the world makes you put central attention on the market makers and on market microstructure, which is just not the case in standard economics, right? We think about supply and demand, and you don't think about the dealer in the middle, bridging supply and demand, absorbing inequalities between supply and demand on their own balance sheet, by buying when no one else wants to buy, and selling when no one else wants to sell, absorbing that on their own balance sheet. And the money view puts these dealers at the center of attention and develops theory of the economics of that. This is what we're going to explore on Friday, the economics of payment systems and the economics of market making, and as the centerpiece of the money view. So far, so good? I know this is a lot at the beginning. I've taught money and banking for a long time, and I have learned that the only way to do it, okay, is to begin with the big picture, okay? Not to build it up in little bits, but to begin with the big picture and then fill in the little bits, okay? So that you see where you're going. That's why we're doing it this way. And we will, I promise you, 1 week from now, okay, you will go back and you will say, yeah, I understand that now, okay. It seems very bizarre and strange right now, but it will make sense to you. I always say this to my students, and I have a whole semester for them, 20, 25 lectures. So it's a longer process, but hopefully we can get it done in a week. When I was organizing these lectures, the organizers asked me to call it Understanding Global Money. And I think that is a very good instinct, because this is another feature of the current system that we find it difficult to wrap our minds around, okay? And so that's not one of my 4 psychological problems, okay? But maybe it's a 5th one, okay? Which is that the system is essentially global today. Okay? We tend to like to think that we live in countries, that our monetary system is the monetary system of our country. We live in Poland, and there's a national central bank of Poland, who I'm going to talk to on Tuesday, and that they somehow control the monetary system in Poland, and so we just need to understand things in our own country, and then somehow we deal with other countries. They are running their own central banks, and that somehow it all gets added up into an aggregate. This is just not the way the world is. It's not a collection of nation states. It's a global system. And each central bank is part of this hierarchy. It's not flat. It's hierarchical, okay, the system. And it's a global system. And the natural form of banking for a global system is shadow banking. So it's not the normal banking that you and I are familiar with. You go into a bank and you ask them for a loan, and they ask you, do you have a job, and how are you going to pay me back, and that sort of thing. It's a different kind of banking that we've developed for the global system, in which loans are packaged together and securitized, and they're funded in wholesale money markets. So it's not deposits and loans, it's money market funding of capital market lending. This is one of the challenges for understanding money today in the modern system, is financial globalization. And we need to bring that institutional fact up to the center and make it the center of our attention. And so I want to say a few words about that. We will be coming back to this in lecture 5, but this is, everything else from now on is just sort of preview of coming attractions to help you see where we're going. So here is my picture of the global hierarchy of money. I should say global, not international here. With the dollar is the world currency, world reserve currency. It's connected to other major currencies through this set of swap lines between the central banks. These are the 6 central banks that I mentioned before, the ECB, the Bank of England, and so forth. Farther down the hierarchy are other currencies, other nations, other central banks that have bilateral swaps, regional pooling, the IMF. They're connected into the system lower down. National monies, like Polish money, is down here, and the whole credit system. So there's a hierarchy in each country, but there's a hierarchy globally as well. And everyone is in that hierarchy at some place. And to understand your dilemma, you need to know, where am I? Where am I in this hierarchy? Okay, you are down here at the bottom, okay, right? And basically, I am too, but I'm down at the bottom of the US hierarchy, you're down at the bottom of the Polish hierarchy, and those are different places in the hierarchy as individuals. But if we talk about our central banks, where are the different central banks, right? The Fed is up near the top, the National Bank of Poland is a little bit farther down. So thinking about it as a hierarchical global system is essential for making progress, not thinking in the abstract about what is the problem of a central bank and imagining this abstract central bank. What is the problem of your central bank? Where are you in this system? It's going to be different. It's going to be different if you're in some country that's not even hardly monetized, doesn't have much of a financial system. Poor country, as opposed to a middle country, as opposed to one of the majors. It's a different problem. This is a picture from the center of the system, okay, from a recent publication of the Bank of International Settlements, which is a very interesting organization that is basically a talking shop for all central banks to talk with each other. This is a wonderful paper, Breaking Free of the Triple Coincidence, published by the research director, in which he's critiquing standard economics and saying standard economics imagines there's a triple coincidence between the GDP area, okay, the currency area, and the actor. So it's representative agent. It's thinking that private and public are one thing. Okay, it's thinking that every country is its own currency area, is its own GDP area. And he says that's just not the way the world is. Okay, it's a global system, and the currency area is the globe. It's not the national system, and the world currency, the global currency, is the dollar. And these pictures are meant to show the flows of deposits and loans in dollars. Maybe this is a little small for you to see, but you can see the arrows anyway, and you can see that that's a map of the world. There's the United States there, here's Europe, there's Spain, and it looks like even maybe I guess that's France. Warsaw's over here somewhere, okay? And it's showing that the global trade in dollars, borrowing and lending in dollars, could be happening entirely within Europe, okay? That some Europeans are depositing dollars have deposit accounts in dollars in some European bank, and that same European bank is making dollar loans to other Europeans. So that there's people trading dollars having nothing whatsoever to do with the United States. Okay. The euro-dollar system. By the way, a lot of this he's showing Europe. One of the things the BIS is most concerned with today is that this kind of thing is going on outside the United States with emerging market countries, with South America and so forth in particular. We'll talk about some of that. This second one is showing that sometimes it can happen that the deposits are coming from the United States, going to Europe, and then being recycled back to the United States. Why would that ever happen? Actually, that is exactly what happened in the shadow banking system that broke in the financial crisis. It was US money market funds that were funding Deutsche Bank and Union Bank of Switzerland, who were buying US mortgage-backed securities. And that is the shadow banking system that collapsed, that caused the global financial crisis. It was exactly this kind of round trip, okay? It could also be going just one direction, dollar funding of European loans, or dollar funding of American loans, European funding of American loans. So it's a global system, and the global currency is the dollar, and it's private dollar. It's the liabilities of banks, not the liability of the central bank. This is a challenge. You can see that it's not a different challenge from the four that I mentioned, right? This is about hierarchy, this is about alchemy. These are all those challenges drawn together, but this is just showing you how those intellectual challenges become important to address for understanding the reality of modern banking. This is the reality of modern banking, that it's a global system, a dollar system. And that global dollar system also has this alchemy. I mentioned that the alchemy is the hardest one for economists to understand. And now I'm showing you alchemy at all layers of the system. The first line there is the line you remember from a half an hour ago, where I first introduced banking, and I said all banking is a swap of IOUs, right? That the bank is saying, I owe you $1 million, that's the deposit account, okay? And I'm saying, I owe you $1 million, that's the loan. We're going to see that in a minute. I'm going to talk about how mortgages actually work. That same swap of IOUs happens between central banks and banks, a different layer in the hierarchy. And that's how lender of last resort works. That the central bank says, okay, I owe you, they create currency from thin air. And the bank says, no, I owe you, that's a discount loan to the banking system, and that's an expansion of balance sheets at both layers. And the same thing happens even higher up than that in the hierarchy. That's what these liquidity swaps are between central banks, between the Fed and the ECB I'm showing here. That the Fed says, I owe you dollars, the ECB says, no, I owe you euros, okay? The effect of that is that the ECB has a deposit account, a new deposit account, at the Fed, of dollars, which they can lend to European banks to help them roll their funding, this round-trip funding that disappeared, that caused the global financial crisis. It was this liquidity swap operation that put a backstop on the system and kept it from collapsing. It's actually the alchemy character of it that saved it, that made it possible to save it. So if you think alchemy seems like fraud or wrong or something, and we should eliminate alchemy, okay, you're eliminating lender of last resort. You're eliminating the ability to put a floor on the system when it's in a crisis. So think again, okay? Be careful what you wish for. You need to understand how the system works in order to make wise proposals for reform. And it's this alchemical feature of it is an important source of elasticity in times of crisis, and also in times of boom. This is what makes booms possible, is this kind of credit expansion. Okay, maybe I'll pause for a minute here, because we have plenty of time. What I want to run through in the next 3 slides is just to give you a little example of how to use this balance sheet approach to think about the nature, where do these commitments to pay, where do these promises to pay come from? How do they move around the system? How does it all work? This is gonna, I put in these slides too because I know that one of these days we're gonna talk about this article by Werner, who talks about one aspect of this but not another one, and standard economics talks about another aspect but not one. So this is trying to pull together and be a resource for the conversation we have later on in the week. A lot of what I teach in money and banking is making students good at breaking down a transaction and doing exactly this, running through the balance sheets. And it looks easy when I do it. Okay, let me tell you, it's not so easy. You have to really think about it and work on it. And in the exams, students fail at this all the time, okay, in the midterm, because then they realize it's not so easy. You have to think differently to be able to do this. There's no math involved, you know, there's no calculus, there's no higher math, but it's thinking, and it's not so easy. But this is the essence of the approach that we're going to be going through. Basically, so this is a preview of Friday, okay, when we do the fundamentals of the money view. There's no new psychological obstacles here. I'm just putting this here so that you'll hit some of those psychological obstacles right here in lecture 1, and you'll realize, oh my God, I do have that psychological obstacle, okay? So I'm showing you here an example of a purchase of a house, okay? There's 3 stages to it that I'm showing you here first, which is, the idea is that I am going to make a purchase of a house, and I'm going to my bank, okay, taking out a loan, a mortgage loan from that bank. And I'm showing in the very first line the alchemy of banking, right? You recognize that. The bank says, I owe you $1 million. This is New York we're talking about, so $1 million for a 1-bedroom apartment, you know. So that's the deposit account of the bank, that's an asset of me, and the loan is an asset of the bank and a liability of me. So the alchemy of banking is what gets this whole thing started. Okay. The second thing is that now I make a payment by transferring my deposit account to you. You own this house, okay? And you sell this house, so it's minus house as an asset. That was a house that you owned, and plus deposit. And that deposit account is a liability of your bank, which is not the same as my bank, okay? So there's a transfer of that deposit from my bank minus deposit liability to your bank. How does that happen? Okay, one way it could happen is by a transfer of reserves, but in order to make the example interesting, I'm saying that the bank doesn't have enough reserves. This is a very big mortgage. And so the bank borrows the reserves from your bank. The federal funds market is a wholesale money market in which my bank can borrow Fed funds from your bank, and that's how this payment gets made. Not by a transfer of money, okay, this is all credit all the way down, okay, that there's an expansion of balance sheets of my bank that at the end of the day, that expansion is still there. There's an expansion of the balance sheet also in your bank, and there's interbank balances here where my bank is borrowing from your bank in order to make the payment. So there's 2 payments here. One is a retail payment. I make a payment to you, you transfer the house to me. Then behind the scenes, which you and I never see in our lives, but if we were bankers we would, okay, my bank has to pay you. How does that happen? That happens by my bank borrowing from your bank, okay, in order that it will later on, if it gets reserves, it can pay this back. Okay, it's credit all the way down. I'm not showing any actual transfer of reserves yet. We're going to see. So far, so good. This is the first stage, payment. And it's showing elasticity. It's showing the way that the expansion of bank balance sheets makes it possible for me to buy a house even though I don't have any money. I don't have any money. The money for me to buy the house is being created at the moment of the transaction, as a matter of fact. And who is funding this transaction? Like, I'm borrowing, but who am I borrowing from? This is important. Who am I borrowing from? Well, I'm borrowing from my bank, but they're borrowing too, right? At the end of the day, they're borrowing from your bank. And who's your bank borrowing from? They're borrowing from you. So the person who sold the house is the person lending the money for me to buy the house. They're lending the money to their bank, who's lending it to my bank, who's lending it to me. It's a round trip. The expansion of balance sheets has made it possible for me to buy a house that I didn't have any money for. It's made it possible for you to sell a house to somebody who didn't have any money, and you're selling it by lending the money to make it possible. Is that kind of mind-blowing? Okay. This is the alchemy of banking in practice. Okay. But that's not the end of the story. That's the elasticity part. That's facilitating transactions. This is the elasticity part of the transaction. Later on, which I'm going to show in the next slide, the question is, you have made it possible for me to buy the house by lending me the money. But that's just because you wanted to sell the house. You have some other idea about what you want to use this money for, presumably, and maybe you don't want to hold it in money form. You want to buy something else with it, and so it's going to move out into society and have other effects. And these knock-on effects are going to be important, and we need to keep them in mind. This may not be, in an economic sense, a portfolio equilibrium, that you may not be content to just hold the money balances that you just sold a house for $1 million. Who holds $1 million as money balances? You're going to spend them. You're going to use them for something. And so there's not portfolio equilibrium yet in the system. And how does that happen? That's the discipline feature. We've gone through the elasticity feature. Now we're going to have the discipline feature. I'm going to show you one possible way this could work out. One possible way is that you spend on whatever you're going to spend. This deposit accounts get spread around in society, and eventually somebody decides they want to use this for their retirement. They want to buy an annuity. Okay. An annuity is a promise to make regular payments monthly until you die. So it's a good retirement asset. And I'm showing that annuity as being sold by an insurance company. That's very often the case, that it's insurance companies that are in this business. So society is taking that deposit and converting it into an annuity. That annuity, and so the insurance company is issuing a new liability, this promise to make payments for as long as you live, as long as whoever has the annuity lives, and they're taking this one-time payment as payment, this deposit. So far, no change. Society as a whole is still sort of holding the deposit account, okay, because the insurance company is part of society. But this is not going to be a good business transaction for the insurance company. They're making a promise to make payments for as long as you live, and they're holding $1 million of cash. You know, that's not going to cover that. They need an earning asset in order to make it possible for them to make that kind of promise. So the second line, I'm showing that they use that deposit account to buy a loan or a portfolio of loans or a mortgage-backed security or something like that from the bank that issued it. Okay. So my bank that made the initial loan sells that loan to the insurance company, which is going to use it as the asset to fund the annuity liability that they have. So now the bank has sold that loan. They use the results of that sale to pay back the Fed funds borrowing that they had made. That pays back your bank, and all these balance sheets now collapse back. This is the discipline feature. I showed how the payment in the first place was made by expanding the balance sheet of the banks, expansion of credit, and now there's a contraction, and the ultimate funding of this is that society wants to fund it long term by holding an annuity. So there's saving for long term, and the loan is the other side of that, is funding that annuity. So the money balances, the expansion of the money supply that made it possible for the payment has now contracted back up. But there's an ongoing expansion of credit. The credit is still out there, but the money is not. So it began by an expansion of the money supply, and then it became a long-term security. It began higher up in the hierarchy, and then it got pushed down lower into credit. This is one way that it could resolve itself, that there's an expansion of balance sheets and then a contraction. There's elasticity and then there's discipline. Yeah, this is not new. This is new. This is hard, okay? But there's another way that it could happen. In this case, I'm showing that society does want to hold this deposit account, but they would rather not hold it in a way that bears no interest, so they put it into a money market mutual fund. And the money market, into money market funding, and there's a special purpose vehicle created, which takes that funding, takes the deposit, and then uses the deposit to buy residential mortgage-backed securities. So it's the same as the insurance company, except that now the liability is not an annuity, okay, but it's wholesale money market funding. And this special purpose vehicle is a shadow bank. Money market funding of capital market lending. It's a shadow bank. It's buying the loan from my bank. The bank is using that loan to pay back the Fed funds borrowing. And so the bank's balance sheets are shrinking. So there is a shrinking back of the private money supply as issued by the banking system, but there's an expansion of shadow banking. There's an expansion of wholesale funding. That's another way that this could play out, so that the ultimate discipline. And this is the way a lot of this worked out before the financial crisis. That the financial crisis involved a lot of transactions like this, where there was a huge mortgage expansion in the United States that was funded in world wholesale money markets, okay? Just like this. And it was this transaction that then came under stress in the financial crisis. It was this kind of balance sheet operation that was supported by those prices shifting around in order to attract funding to keep this thing in Europe, okay, where the Deutsche Bank had to bid up for funding. And it was this kind of thing that was supported by the balance sheet of the Fed to keep it all from collapsing when nobody would lend the money. The Fed itself went into the shadow banking business. Did you hear that I said that? The Fed itself went into the shadow banking business, because what are they doing here? They're expanding their balance sheet on one side. That's the money market funding part. And what are they using that for? They're using it to buy residential mortgage-backed securities. That's the capital market lending part. The central bank of the United States took onto its balance sheet the collapsing balance sheets of the European banks that had been operating in the shadow banking sector. That's what prevented the global financial system from collapsing, was the lender of last resort, market maker of last resort operations of the Fed. Okay. So this is coming full circle from where we started. All right? I'm not going to blow your minds anymore. That's it. I want to just give you a preview, just maybe a little summary here. Next time, we're going to talk about some of the history of money and finance ideas. And I want to just lodge in your mind now for tomorrow the idea that the evolution of the history of economic thought, sometimes we think of it as a story of progress, right? That we used to be stupid and now we're smart. You know, that we used to not know very much and then we learned a little bit and then we learned a little bit more and so now we're smart. And so we don't have to know the past, because everything that we know that happened in the past was sort of stupid. And now we're at the most knowledgeable we ever were. Okay. You will see this is just not the nature of the evolution of economic thought. Okay. The system we're trying to understand is in constant motion and it's changing. Sometimes it's moving and it's in a boom phase. It's the elasticity of credit. Sometimes it's in a discipline phase. It's the discipline of money. Sometimes there's wars and it's all public money. It's all government finance. Sometimes there's peace and it's all private finance. Sometimes all the action is in the periphery, where sometimes all the action is in the core of the system. And of course, economists, being human, are paying attention to where the action is. What's happening right now? What are the issues in the world right now? And then 10 years from later, the issues are different. And so they stop paying attention to that. And they pay attention to something else. So this is the point, that system dynamics and thought dynamics, okay, are intertwined. that the evolution of monetary thought comes along with the evolution of the system as a whole. So it's very often the case that very good insights that might be helpful today for problems today were last really evolved when those problems arose 50 years ago. Okay, so sometimes I say we're in this movement now of financial globalization. So that the economy today, the monetary problems of today, are much more like the problems of 100 years ago, when the era of globalization under the pound sterling, okay, than they are the problems of 50 years ago, right after the war, when there really weren't any global financial markets or global money markets. However, our textbooks are caught in 50 years ago. So don't look at the textbooks, look at what was written 100 years ago, and translate it for the modern world. Because of course 100 years ago, they didn't really have organized electronic financial markets and instantaneous transfer of funds around the globe, much less Bitcoin and all that, But the principles that they had to engage with are very much the same. So we can learn a lot by reading Bagehot, by reading the works of the high period of the gold standard, the sterling standard in the late 19th century, before World War I. Here's just some ideas, some things that we're going to be talking about tomorrow about the evolution of monetary thought. That sometimes the focus is on the elasticity of credit. This is and when you hear about the banking school, this is the banking school tradition, is emphasizing that money is a form of credit and so it's elastic, okay? Sometimes the important thing is the discipline of money, okay? The collapsing down of these balance sheets as you move toward, you realize that this kind of money is in fact subordinate to a higher kind of money. That's what the currency school emphasizes, is the discipline of money. So this constant battle between the currency school and the banking school is not a battle that anyone ever wins, because neither one is right. Each one is emphasizing one dimension of the system, a dimension that may be of vital importance for a particular moment and then not of vital importance for a later moment. So really the argument is about which of these traditions is the one we need to be emphasizing today for the conditions of today. It's not about which is the correct monetary theory for all time. There is no correct monetary theory for all time. It's a question about which of these traditions is talking about the reality we are confronting. Similarly, bankers' bank versus government bank. Some people like to think of the central bank as if it's a private institution, as if it's just a bank for other banks. Some people like to think of the central bank as the bank for the government. Well, both of these things are true about central banks, but at different times. In war finance, all central banks become government banks. They're just funding the war, expanding their balance sheets, causing hyperinflation if necessary, whatever it's needed. You're trying to win the war, but in peacetime, different. A current issue that we're grappling with is this issue of moving from a bank lending kind of world to a capital market kind of world. So bank lending versus market credit, shadow banking versus our familiar. This requires us to bring into monetary economics a lot of financial economics, because we need to understand how these capital assets are priced and things like that. So there is this demarcation between monetary economics and financial economics, okay, which I'm sure is there in your courses. These are different courses, right? They're in typical universities. I should have asked this beforehand, but it's certainly true in my university. There's a course in finance that's taught in the business school, okay? And there's a course in monetary economics that's taught in the economics department, okay? And these could not be more different courses. They seem to be different universes. What I'm saying is that in the world, it's the same phenomenon. There's no sharp boundary between finance and monetary economics. What is shadow banking? Shadow banking is finance on one side and monetary economics on the other side. You're never going to understand shadow banking if you have these courses separate, where you think that you can understand finance without understanding money, and you can understand money without understanding finance. No, modern banking is shadow banking. You need to have both of them in the same picture. That's relatively new. And core versus periphery, that the issues in a global system are going to be different. Sometimes the system as a whole is in expansion mode, as it certainly was before the crisis, as it's trying to be again right now. But sometimes it all collapses down, and the only thing you need to understand is national finance, because there isn't a global system. So monetary thought follows monetary practice with a lag. But because these books live in the library, okay, we can jump ahead, okay. We don't have to wait for monetary economics to catch up with reality. We can go back and find analogies in history that help us understand the world today, and the theory that was developed in that period, start there and work on that for understanding the theory that is appropriate for today. That's what we're going to talk about next time. And here's the last slide. So this is about this afternoon. I understand that we're going to have some presentations about inflation. And so I just want to say a few words about how the money view connects to the theory of inflation. This will be helpful particularly maybe for the presenters. You remember that slide that I showed you about the hierarchy of money and showing the market makers and the prices of money that they were making? There were three that I mentioned there. Okay, there was the exchange rate between national money and global money. There was par between private money and public money, and there was the rate of interest between money today and money tomorrow. Okay, or between money and securities. Okay, those are three prices of money. There's a fourth, okay, which is the price of goods in terms of money. And that's the price we're concerned about when we think about inflation, okay, the changing price. What a natural way to think about inflation from the money view perspective is to think about who is making those prices. You know, what are the relevant dealers here? How would we expand the money view to develop a theory of inflation? It would be thinking who are the market makers in primary commodities, that in the markets for oil or wheat or other primary commodities, not only are there cash markets, spot markets, where you are buying oil now, but there's futures markets, forward markets for forward delivery. And there are inventories and savings and warehouses of this stuff. So there's a dealer function that is making these prices in commodities, and there's an implicit interest rate involved there, just as there is in the dealers in securities and so forth. So there are commodity dealers, and that's what you would focus on, or at least that's one place to start in thinking about how the money view connects to this theory of inflation. And we will see in what ways people are doing that or are not doing that in these papers this afternoon. Another connection is thinking of labor itself as a primary commodity, a primary input, and thinking of unemployment as a kind of inventory of labor. And the question is, what is the dealer system that is moving people back and forth? And this proposal of a job guarantee, right, that we're going to talk about, is essentially saying the government should act as dealer of last resort in the labor market. You know, that they should be willing to buy labor at a fixed price, okay, and that will support the price of labor and make sure that people there's full employment. Okay, that's one thing, but it really is about the buffer stock. It's thinking about it from that point of view. So I guess the bottom line that I would say is that for turning the money view into a theory of inflation, which I haven't done, okay, which hasn't really properly been done. This is mostly work to be done, but you can see some of these articles kind of moving toward that direction. My recommendation would be you want to put the economics of the dealer function at the center of attention in order to think of who's making that price. And are they a profit-seeking dealer, or are they a stability-seeking government? Or who are they, okay? And what are these commodities that are creating the price level? Is it primary commodities or is it labor in different parts of the system? So I think that there can be a money view theory of inflation, that it would be a good idea to develop such a thing. That has not, I think, to my mind, been done properly. I think we kind of know what we're doing when we talk about par and the exchange rate and the interest rate. There's lots more work to be done there, but there's more fundamental work, I think, to be done in thinking about inflation and the price level, and hopefully we'll make some progress this afternoon. So I think that's the last one. Yes, it is the last one. So we are now at 11:18, and I guess we have the room until 11:30. I don't know, do you want questions or?
Yeah, maybe.
Okay, I'm happy to take Questions about anything, really, because we're here for a week. So if you want to absorb all of this for a while and the question in your mind is about something else, that's fine. Do you want to pass the mic around?
Well, the major question is whether the presentation will be available to us.
It's okay with me, I think so, yeah. It's being taped, by the way, and so there's a videotape of the whole thing as well. But the PowerPoints are certainly, I will leave them behind. Yeah, they have them on the computer here. Yeah.
I have many more questions, but I probably will send you my email.
Okay.
I think we'll share the PowerPoint presentations on the event on Facebook. Any questions? I'd like to ask about are there any sources for better understanding or visualizing the things that are taking part in the spreadsheets, or how the banks are loaning money to private banks, and how to better understand it, or are we going to be provided with those resources to learn from, or can you recommend anything?
Yes, I'm used to speaking without a mic, so I'll do that from here. One thing to be aware of is that there's a tremendous amount of information that's publicly available because central banks are public institutions. So the balance sheet of the Fed, all of that information that beautiful Alice in the Wonderland through the looking glass picture, is all from balance sheets that are available on the Fed's balance sheet, on the Fed's own website. They publish their balance sheet weekly, in real time. We can, if there's an internet connection here, I can show you what the balance sheet looks like right now. And you can drill down and see that. And a lot of what I was doing in the financial crisis was waiting for Thursday when they would publish, what's the new thing they've done in the last week, and you can see that. Other central banks are not as real time. They publish with a lag of 3 months or 6 months, but that information is typically there. A very important source of information that I look at these days is the Bank of International Settlements, because it's a global system, and the only one who really has a global point of view is the Bank of International Settlements, because they have the balance sheets of all commercial banks, all central banks, all that data they have, okay? And they publish it, a lot of it is proprietary data, so you're never going to get it, but they publish a lot of data in aggregated form, so that you can't see the balance sheet of individual banks, but you can see exposures of different countries. You can see the nature of the global system, and they continue to develop their data service too. So and all of that is online. If you go to the Bank of International Settlements and just look at their working papers or look at their quarterly reports, I read these reports avidly. Okay, this is where you learn the fundamental features. The other thing that I would recommend to you, so I'm not assigning those, but those are resources, and I can give you the URLs for them, or you can just find them. They're available. The other thing that a lot of how I developed this point of view was by continuous reading of two sources. Okay, one was this great book about the US dollar money markets, written by Marcia Stigum, called The Money Markets, that's gone through 4 editions now. She's dead, and so it was just updated by somebody else. And it's all really kind of out of date now. But the point is that it was one book for people who are trading money markets. It was a trader's manual. It wasn't a textbook. And I used to teach money and banking out of that textbook. I said, this is the Bible of the wholesale money market traders. We need to understand how this tribe works, so we need to read their Bible and really just keep reading it until we understand it. So that's where most of these lectures came from. The other resource was the Financial Times. That the Financial Times is an international global paper published in London, but that's important because London used to be the center of the global system and still is really for the private money markets. It's the center of the Eurodollar system. What will happen after Brexit? Who knows? But the FT is their house organ in a way. So reading the Financial Times daily, choosing an article and really trying to understand it, trying to translate it into balance sheet terms is a way to start to understand how the system works. This is what I do in my class. If you've seen the MOOC, you know that the first 10 minutes is always take an article from that day's Financial Times, okay, and translate it into balance sheets. And if you just do that, and that was really helpful for me in learning that discipline, promising to students every day for the next 3 months, you know, I'm going to come in and I'm going to do an impromptu lecture on something that was that day's newspaper. That's a lot of intellectual discipline. You know, professors, that's a lot of work, you know, to challenge yourself. I don't know what they're going to publish, you know, and in the fall of 2008, you know, I wasn't actually teaching in the fall of 2008, it was the fall of 2007, as the thing was starting to collapse. In real time, we're going through this and saying, something's happening in Europe, look at that spread, you know, something's, you know, look at what happened to this, look here now, Citibank has just said, oh, we've lost $3 billion, it's beginning, okay, and then 3 weeks later, it's now $8 billion. No, it's $16 billion. So watching the system as it's evolving in real time is, I think, very helpful for eventually coming to understand how it works, because it's evolving, it's changing, and you get clues about how it works by watching the financial news. But this is not going to be in normal papers. It's going to be in the financial press, in the Financial Times. I think it's still true that the Financial Times is the best international paper. It's changed ownership. We always regret it's not as good as it used to be, but it probably still is. It still is the best. And there's the conversation that happens on FT Alphaville between people who are very knowledgeable, people who are traders in these markets, you know, is very helpful. Glimpse into this world. But it's the right question. You're asking, how can I, you know, sitting in a classroom, you know, there's this whole world out there. How do I overhear it? How do I get access to it? How do I get information about it? I've just given you a few ideas about places where you can lurk and you can like watch and listen until you're ready to talk, which may be years. I lurked for many, many years. You know, it was 15 years before I published this course, you know, before I created a blog, because I didn't know what I was doing. I had to figure it out. The students learned with me. We were reading Stigum for the first time ourselves, reading the FT for the first time ourselves. The first students who took this class, 15 years, I hope they're okay, because I think they are okay. I know some of them. But it was, you know, by the time it got very polished, now you see it, okay? It took a long time. It doesn't happen overnight. And the world is changing. I'm going to talk next time, actually mostly to the central bank, about the way in which the financial regulation, the attempts of people to change the system after the crisis, how that's changing the landscape around us. And it's not stable. We're just trying this, okay? And it will be tested in the next crisis, and parts of it will break, and then we'll change it again. You know, that's the nature of the system. What I'm trying to teach in this class is some principles of analysis that will not ever go away. They will always be useful, okay? Even as the system itself changes, you can still think of it. It's always going to be a payment system. There's always going to be market makers. They're just going to be different. The location of these functions is going to move around. The way in which they're supported by the state or how they're integrated to the global system, this is going to move around. All that stuff going to move around. But the ultimate functions of the system are going to be there. They're true in all monetary systems, in all times, in all places. Sometimes more sophisticated, sometimes less sophisticated. So I'm hoping to give you some principles that will not let you down, even if Poland is very different from America, you know, and they still will not let you down. You will be able to use these principles to understand the problems that confront you and your country. That was a bit of a long-winded answer, but it was an important question. Oh.
Any more questions?
Slide with the spread on dollar
0. And my question is, were there any time periods that the spread was different than 0 after the crisis, and what might be possible reason for that? And do you think that this is a good indicator for volatility on global markets and for the future financial crisis? Because I remember you said something similar to that.
Yes. So the question is about the spread, which in this picture here is the spread. One of these lines is the 1-month interest rate, and one of them is the 3-month interest rate. And we're comparing here the U.S. dollar overnight index swap with the LIBOR, London, which is euro-dollar rate. Overnight index swap is for the Fed funds, so it's kind of a domestic interest rate inside the United States and an outside the United States interest rate, and it's showing the spread between those, not the levels, so that it is 0 before the crisis, and it's 0. You can see as of the end of 2009, it goes back to 0. The question is whether this spread, what happened after 2010, okay? And you're right, it has in fact opened up again in the Euro crisis time and even more recently. And there's other spreads too, and we're going to talk about those, I think, in Lecture 5, Understanding Global Money. One of the most interesting things that I've written about the breakdown of covered interest parity. Okay, this is actually also the breakdown of covered interest parity. Is another way to understand that. Covered interest parity is broken down even now, even today. Okay, right now. Okay, and the question is why. Okay, the BIS is very concerned about this. This is a principle that in all of our textbooks we treat as basically a fact about the world. That covered interest parity is just basically true because it should be riskless arbitrage, and if it doesn't hold, then there's a riskless arbitrage for somebody, and so why don't they just do it? Okay, is it because of regulation is preventing people from doing this arbitrage? This is one point of view you hear. Is it because of some kind of unmeasured default risk somewhere? I think this is about markets trying to price liquidity, and so I do think that it is a sensitive barometer of conditions in the global financial system. And we are going to talk about some of this. You're going to see a longer time series than this in a later slide, so we'll come back to this question. This was crisis times, right? And so in crisis times, yes, markets broke down, and so risk arbitrage relations broke down. Makes sense. Are we living in crisis times now? You know, it doesn't sort of feel like it. Markets are working, and yet there are spreads like this. So this is something, and this is new. Before the crisis, there were never spreads like this. Never. Now, after the crisis, there are spreads like this. So something has changed in the system, even in normal times. It has not reverted back to the way it was before the crisis, and that's something to be understood, something to be watched. So we will be looking at that. So let me postpone the actual, because I don't think probably it's on here somewhere, but we will be looking at that data and coming back to this question. Is this time?
Yes.
Okay.
This was the last question. During the workshop, you'll have an opportunity to ask some more questions to discuss different methods. Now we're going to have a lunch break, and